Get ready for the ultimate showdown. Manulife Financial versus Sun Life Financial. Only one can claim the crown. Buckle up, people, because you're in for the battle of your life. You don't want to miss this epic face-off. Welcome to the vast and dynamic world of Canadian insurance, where two industry titans, Manulife Financial and Sun Life Financial, continue to make waves. These powerhouses have carved out their own niches in this competitive landscape, offering Canadians a myriad of financial solutions to cater to their unique needs. From life and health insurance to wealth management, these companies have got it all covered. Manulife Financial, a true leader with a rich history dating back to 1887, stands tall as one of Canada's largest insurance providers. With a keen focus on innovation and a customer-first approach, Manulife has diversified its offerings, extending beyond insurance to include banking, investment management, and retirement solutions. Their robust lineup of products and unwavering commitment to excellence makes them a force to be reckoned with. On the other hand, Sun Life Financial, established in 1865, has been a shining light in the Canadian insurance industry. As one of the country's oldest and most respected financial institutions, Sun Life offers a comprehensive suite of insurance and investment products designed to help clients achieve lifetime financial security and live healthier lives. With a global presence and a commitment to sustainability, Sun Life continues to push the boundaries, developing top-notch services that empower individuals and communities alike. Both Manulife and Sun Life have solidified their positions as pillars of the Canadian insurance landscape. Whether it's by customizing policies to fit clients' needs, harnessing technology to enhance customer experience, or building robust investment portfolios, these two giants remain at the forefront of the industry, determined to redefine the future of insurance in Canada and, of course, beyond. Join the conversation. Let me know in the comments if you are invested in either or both of these insurance giants. Your participation is well appreciated. Don't forget to like and subscribe to stay up to date on future content, and a huge thank you for that click. From an investor's perspective, Manulife Financial and Sun Life Financial each present a unique blend of opportunities and risks. Manulife, known for its strong presence in the North American and Asian markets, offers investors exposure to growth in emerging economies. However, it may be more susceptible to economic fluctuations and, of course, regulatory changes within these regions. Sun Life, on the other hand, boasts a more diversified global footprint and a solid reputation in the insurance and asset management sectors. While Sun Life's stability and focus on sustainability may be appealing, its growth potential might not be as pronounced as Manulife's. Absolutely, we're all hyped for this epic face-off. Brace yourselves as we deep dive into their fundamentals, putting them head-to-head in a thrilling three-round battle. No stone will be left unturned, and rest assured, when the dust settles, only one will emerge victorious. This is a showdown you don't want to miss. So in round one, we will, of course, dive into their surface data and perhaps set the pace for this showdown. Up first, we will start with Manulife Financial. They have a market cap of $47.46 billion and a pretty average beta at 1.11. Their earnings per share comes in at 3.68, and they have a price to earnings ratio of 6.76. That's not too bad. Their return on equity comes in at 12.46, and their revenue is projected to grow by 26.24% per year. That's not too shabby. When it comes to their fair value, they are undervalued by a whopping 51.3%. By looking at these initial numbers, I am really getting the sense that Manulife's got a lot of growing to do. Let's turn it over to Sun Life and see what they can do in this surface data round one. Their market cap is a little bit lower at $37.43 billion, and their beta is slightly less volatile at 0.97. Their earnings per share come in at 5.21, and they have a slightly higher price to earnings ratio at 12.04. Their return on equity, that comes in at 11.09%. Their projected growth per year comes in at 14%, so they're not quite hitting the same numbers as Manulife, and it reflects when we look at their fair value, they are undervalued by 47.3%. Wow, this round was much closer than I expected it to be, and that is great as we are in for a real battle here. However, the first round does go to Manulife Financial for the simple reason that they are much more undervalued than Sun Life, as reflected by their PE ratio and, of course, their fair value. Manulife also just eked out Sun Life in their return on equity, and you guys know I really love return on equity. All right, let's move to round two. Round two is all about dividends and returns. Which company is going to give you the most bang for your investing buck? Once again, we will start with Manulife Financial. We will kick it off with their dividend yield, which comes in at 5.979%. That's paid out quarterly in the amount of 36.5 cents per share. Manulife Life is a dividend aristocrat with a 9-year streak of raising those dividends. In fact, they just announced a dividend raise with their last earnings report. Their payout ratio comes in at a very stable 35.87%. Their dividend situation is definitely very stable. Let's look at their overall growth. So their 3-year return on investment, that comes in at 54.68%. We factor in those dividends, we get a total return for 3 years of 72.43%. Switching back to 1 year, for 1 year, they did have a return on investment of negative 5.45%. Factoring in the dividends, it did knock it down to negative 1.53%. In 2023, their return on investment is 1.89% with a total return of 2.99%. Now, when it comes to these returns, they are definitely outperforming the market, which is great. Okay, let's look at Sun Life. Sun Life has a slightly smaller yield at 4.678%, and that is also paid out quarterly in the amount of 72 cents per share. They are also a dividend aristocrat, though they only have an 8-year streak of raising those dividends. Their payout ratio a little bit higher, 52.98%. Still sustainable though, so we do have to give them that. Looking at their growth, for their 3-year return on investment, we get 47.43%. Adding in dividends, that gives us a total return of 64.96%. Switching to their 1 year, their 1-year return on investment is negative 10.92% with a total return of negative 6.90% after we add in the dividends. When we come to their current year for 2023, we get a return on investment of negative 1.15% and a total return of negative 0.02%. These are still, once again, beating the market average. Overall, though, when we do look at round 2, we're also going to award that to Manulife Financial. They both did well and outperformed the TSX, but Manulife consistently brought back the bigger returns, and as an investor, that holds a lot of weight. Sun Life is definitely on the ropes, and we will have to hope for a knockout in the final round if Sun Life has any chance of winning this battle. Round 3 is, of course, all about debt, and it can often be the one thing that decides if a company sinks or swims, especially in a higher interest world. As usual, we will start with Manulife Financial. They have a total debt of $24.381 billion and total equity coming in at $56.379 billion. That gives them a debt-to-equity ratio of 43.2%. I can definitely respect that because anything under 100 in a financial company is absolutely a-okay with me. When we break this down a little further, their short-term assets come in at $80.85 billion. Their short-term liabilities come in at $17.19 billion. That's pretty good. Long-term, their assets come in at $768.09 billion compared to their liabilities of $775.37 billion. Overall, their debt's not that bad. Their actual debt, it is well covered by their cash flow, and that is, of course, fantastic. The interest on that debt is also well covered by their earnings before interest and taxes, which we call EBIT. In addition to that, their debt-to-equity ratio is moving in the right direction as it has fallen from 46.2% to 43.2% over their last 5 years. Anytime I see a company reducing debt, I love that. Let's switch over to Sun Life and see what we have in their debt book. Their total debt comes in at $18.534 billion, while they have in total equity $29.377 billion. Now that gives them a debt-to-equity ratio of 63.1%. Still a good number, a little bit higher though than Manulife Financial, so that's going to play a role, I think, in this round. Short-term, their assets come in at $99.32 billion, liabilities $12.09 billion. I like that. That's pretty good. Long-term, their assets come in at $231.59 billion, and their liabilities come in at $289.44 billion. This entire short-term and long-term asset situation looks very much like Manulife's, although the numbers are slightly different. Their debt is well covered by their cash flow, and that is great. The interest on that debt is also well covered by their EBIT. The only real downside to their debt is that their debt-to-equity ratio has been increasing. It rose from 47.3% to 63.1% over the past 5 years. Oh dear. Once again, this round goes to Manulife. They have similar debt, though Manulife has a little less, and they are moving that debt in the right direction. Based on that alone, they score the 3rd round. Okay, who is the winner of this battle? It goes without saying that Manulife dominated from the opening bell, and they edged Sun Life out in every category, making it a pretty easy call. Make no mistake, I still think Sun Life is an awesome company, and it is not a bad investment by any definition of the word. It's just that Manulife Financial is a wee bit better right across the entire board. Both are great long-term investments, and with them both being undervalued, there is solid potential with them both as half-decent total return stocks. Manulife Financial did win, and you can expect a slighter bigger serving with those total returns, and with less debt, more assurance that they will keep doing exactly what they've been doing. Keep the learning going. Watch my video on US high dividend stocks linked on the left, or test YouTube's recommendation skills by checking out the video on the right. Your choice will decide the winner, and I will see you in the next video.